Hola, Carlegaju, gerente de distribución institucional en BICE Inversiones, y les doy la bienvenida a nuestro webinar de hoy. Hoy nos acompaña Nathan Shetty, Head de Multi-Asset de Nuveen, quien estará a cargo de la exposición de hoy, Nacubo, TIAA Study of Endowments 2021, donde expondrá acerca del performance, análisis de las inversiones, políticas de inversión y corporate governance de los endowments de educación y fundaciones de los Estados Unidos. Como saben, TIAA es el fondo de pensiones de los profesores en Estados Unidos. Cuenta con más de $1 trillón de activos bajo administración, convirtiéndolo en uno de los 15 mayores gestores del mundo, así como también líder en la gestión de activos alternativos como real estate, real assets y deuda privada. El estudio de Nacubo 2021 representa el cuarto año de colaboración entre Nacubo y TIAA para producir este importante análisis líder de los endowments. En este webinar se presentará una descripción de los recientes resultados de la encuesta anual. Al final de la exposición, como siempre, tendremos tiempo para conversar con Nathan, y por lo que pueden ir escribiendo preguntas en el chat, y después José Antonio Sangüesa las irá agrupando y ordenando para poder responderlas al final de la presentación. Es un placer para nosotros, como les decía, poder contar con Nathan, quien creemos es la persona idónea para conversar sobre estos temas, puesto que dentro de sus responsabilidades está asesorar en el asset allocation del patrimonio propio de TIAA. Por eso no les quito más tiempo y los dejo con él. Welcome, Nathan. Thank you for being here with us today. The floor is yours.
Great. Thanks so much. Thanks, everyone, for joining today's webinar. Let me just give a few comments or a brief background on the organizations that came together, that collaborated to deliver this annual study of endowments and foundations. Nacubo, which is the National Association of College, University, Business Officers. It's the preeminent organization or institution, association, provides information for financial decisions and governance associated with higher education. Of course, TIAA has a 100+ year history of delivering retirement security to teachers. So I'd say that it makes the collaboration between TIAA and Nacubo quite optimal, given the nature of this study in higher education. Now, over the years and over these past 100 years, TIAA has specialized in providing retirement security and designing retirement plans and delivering institutional solutions far beyond teachers, far beyond just the educational sector. And so the Nuveen, which is TIAA's asset management arm, of which I work for, we manage about $1 trillion, a little over $1 trillion in assets. We deliver our asset management in any number of sectors and strategies, from public market equities to public market fixed income, and all the sectors you can imagine there: emerging market debt, high yield, so on and so forth, as well as private markets. We specialize in direct real estate, infrastructure, a very large private credit offering as well. Now, for Nuveen, I run the multi-asset team. We engage with institutions, public pension plans, endowments, foundations, family offices. We engage with them and help them solve some of the most challenging investment challenges that they bump up against. I'd say that my team primarily focuses on asset allocation. Our lens by which we manage money is very much from a top-down macroeconomic standpoint. So that's just a little bit of background in terms of the study and the organizations and where I reside in the TIAA organization. Look, the study covers, as I mentioned, higher education, endowments, and foundations, and all of which are located in the United States. Now, keep in mind, and you see this on the bottom of the slide here, that the performance that we'll go through, the stats, the asset allocation, is built around the fiscal year ending June 30th. So this isn't reflecting calendar years, and that's actually going to be quite important. And I'll touch on that a little bit later on in the presentation. Now, the study covers university endowments and foundations. I'd say that this annual study has become a benchmark. It's become very widely adopted and used by both public and private endowments, foundations, by family offices, and actually a number of wealth management entities as well. And I think that's for two reasons. This study is the most comprehensive of its kind, and you'll see this in the stats. For those of you on the call that have read the full report, it's 100 pages plus in length. I'm not gonna keep you guys here for multiple hours and go through all 100 pages, so don't worry, I'll keep my comments concise. But it is extremely comprehensive and provides a great deal of insight, and that leads to the second reason. That second reason is it reflects a common approach to investing, often referred to as the Yale model or the endowment model of investing. This was popularized by David Swenson multiple decades ago, but now it's a commonly used approach to managing assets in the family office space and the endowment space. So again, this study is actually quite relevant to multiple institutions. Endowments and foundations, look, they exist to support liabilities. They exist to support the operating needs of universities from a family office perspective. It's to be able to provide spending needs and liabilities on an ongoing basis. And you can do this from one of two sources. You can do this by providing contributions or donations on an annual basis, or you can do this by sourcing investment performance from the pool of capital with which we're all managing. Interestingly, the correlation between donations and contributions is quite high and quite positive with market performance. So this past fiscal year, as you see, donations or contributions to many of these endowments and foundations was significantly up year on year, up 15%. And as you'll see, in the fiscal year ending June 30th, market performance was absolutely extraordinary. So that correlation was still fully intact year on year. This makes a lot of sense as markets return, significant performance. Those that are willing to donate or contribute, it creates a degree of comfort to be able to put in additional capital for future consumption. So again, this makes a lot of sense. What this has done is given the increased contributions or donations along with investment performance, it's left most of these institutions, whether it's an endowment or foundation, university, private, or a family office, in a very good and a very comfortable financial position going forward. I'm not going to reflect too much on this slide other than the assets exist, as I mentioned, to be able to serve liabilities. The liabilities in this context, either as an endowment or a family office, tends to be built around a spend rate. And importantly, that spending rate was flat year to year. So if we have this situation where, and it's typically based on, this is 4.5% spending of most universities use an average of the prior 4 years of net asset value to apply that 4.5% against. It's not dissimilar for spending needs of most families as well. There's a smoothing function and then a spend rate applied to that. But that spend rate really hasn't changed year on year. If you net all this out, investment performance was very high, contributions and donations up, excuse me, and the spend rate flat. That means the capital base for most of these institutions is significantly higher than it was at fiscal year end 2020. Now we get into some performance of this prior fiscal year, and as you can see, it looks somewhat anomalous. Is very, very impressive. There's no question that the fiscal year ending June 30th was a period of supernormal returns. The median institution for the year ending June 30th returned 30.6%. Now, again, this is anomalous relative to history. As you can see, it has pulled up annualized performance quite dramatically on a 1, 3, 5, and even 10-year annualized basis. When you go further out and perhaps more akin to time horizons that family offices and endowments manage to 15, 20, 25-year type periods, the impact from 1 year dissipates. That makes a lot of sense because you're annualizing over a much greater time horizon. But just the sheer magnitude of this past year's performance really is something that we haven't seen. Let me provide some context here. The reason I keep mentioning the fiscal year end, particularly associated with the median 30.6% performance, is because this captured what I would consider a very specific time period of nothing other than monotonic or upward trajectory in all asset classes. So coming off the pandemic in March of 2020, when markets troughed, central banks and governments around the world deployed an incredible amount of stimulus, with monetary stimulus and fiscal stimulus. This had the impact of reflating asset prices very dramatically and very quickly, which began in the May-June timeframe. So if we're looking at a fiscal year end of June to June, it really captured that reflationary period quite on the nose. The impact of those reflationary policies started to wane a bit toward the end of 2021. 3Q a little bit, 4Q we saw a little bit of volatility and a bit of a pullback. But the change in asset prices slowed quite dramatically in the second half of 2021. Now, again, that's not reflected in this 30.6% number. So again, it's very important that as you look at these returns of endowments and foundations, you understand the time period with which that's happened. The second driving force for such an extraordinary number is out of the private equity and venture capital space. As you're aware, a lot of foundations and endowments, particularly the larger ones, have significant allocations to private market exposures. What we saw over this past year was a very large mark to market in private markets. Private markets don't have a secondary mark. There's an appraisal process that goes along with this. If you're familiar with that process, they use public market equivalents and comparables of company multiples that are traded in the secondary market to value their company holdings. And because those multiples had expanded so dramatically in the public markets on the back of that stimulus, we saw a paper-based. Now, again, I want to be clear that in the private markets, it's not that the 30% returns that we saw even in venture capital or private equity, sometimes even more than that, was actually delivered in cash. That's just the appraisal-based mark-to-market was rather substantial because of what we saw in the public markets. There was also an incredibly loose liquidity environment, as well as a very opportunistic environment for exits. We saw a lot of VCs and PEs exit some investments and actually post some of those cash returns or internal rate of returns and deliver them to their investors. So the combination of all of those led to a very large contribution from the private side, of which we haven't seen in prior years. Now, I want to just leave this slide with a note of caution. we cannot extrapolate the future from these sorts of numbers. This is a very extraordinary period where the stimulus that drove this asset price reflation cannot be expected to be redeployed in the years to come. In fact, the whole point of the stimulus was to bring growth and ultimately returns forward and deliver that in actually a very concentrated period. If you think about it, we're in essence borrowing from the future. So I would expect, and as we build our capital market assumptions on a quarterly basis, our expectation is indeed that returns both in the public space as a private and the private space are going to normalize considerably going forward. Right. Just on the liability side, even with these very extraordinary returns, the 30.6 dragging up all of these annualized returns, we're barely achieving in the long term the required rates of return that most endowments and foundations are looking to achieve. I think in family offices, you'll see a very similar required or expected rate of return that we need from our broad base of assets. Provide some context here on how this is built up. From a qualitative standpoint, the desire is to be able to retain the real capital base of the portfolio, and real means we have to account for inflation. The real capital base after fees and after spending requirements. As I mentioned on a prior slide, spending requirements held pretty constant at 4.5%. Here is 4.6% is the median spending requirement. Year on year, that really hasn't changed much. But fees have gone up by about 20% of the expectation of fees. I think this is in large part driven by the continued shift and flow of capital into private markets. Most of you are aware private markets command a somewhat higher fee. They deliver a different risk and return profile and command a different fee base, and therefore that needs to be reflected in those expectations. And if the ultimate objective is to be able to cover fees, then the required return goes up linearly with those higher fees that we're paying for the types of exposures that we're embedding in our portfolios. The other area that I wanted to touch on was the inflation component. I mentioned that we want to be able to retain the real capital base. So this is managing against inflationary pressures so that the spending power of that pool of capital for intergenerational wealth transfer for your families. Endowments consider themselves perpetual equity. They want to be able to have spending power after inflation. That's ticked up by about 20 basis points. That doesn't seem like a lot, but this is a long-term expectation. What we found in prior studies is that that tends to be stuck. It's quite sticky around that 2% central bank target that we've seen historically. Well, that's all changing. We're in a new environment. Many of you see, and this is something that's experienced around the globe. Here in the U.S., we've got core inflation 5-6%, headline inflation 7-8%, continues to tick up around the globe. Europe, South America, we're seeing inflation everywhere. This is starting to be reflected in long-term expectations. As you can imagine, it's a slower mechanism by which this will be reflected, but for long-term expectations to move up by 20 basis points, that's a rather significant change. I believe as we settle into a higher inflationary regime, that transitory component that everybody's spoken about starts to dissipate a bit, but we will settle at a level globally that is much higher than we've experienced in the last 20 years. I suspect closer to 3-4% instead of the sub 2%. These expectations are going to go up even further. which means required returns, or just that qualitative expectation of what we need to deliver to our clients, is going to go up past this 8%. As you can imagine, with diversified portfolios on a forward-looking basis, hitting 8% is no easy task. We can move up by another percent. We're talking 9–10% to reflect and manage against inflation. This is a breakdown of the asset allocation by size cohort of all of the respondents in this study. I'm going to point out some trends here. But first, just given the Brinson studies of decades ago, and I think through experience and how we all manage money, we recognize that the asset allocation of a fund is the most important contributor to the outcome that you experience. So these differences based on size cohort will also lead to differences in the ultimate performance. Of course, to some extent, the manager you choose, the active-passive mix, and the like will all provide contribution or detract from total performance. But in terms of its proportionate contribution to total outcomes, it's de minimis relative to what you see on this slide, which is the asset allocation. It's also why my team focuses our efforts and energy on determining optimal mixes given a client's desired outcome. What is the right asset allocation, and how can we be more thoughtful about managing that dynamically over time? It is the key lever by which you can achieve your outcomes. So let me point to some trends here that we see across different organizational sizes. The first of which, I mentioned the Yale model, the endowment model a couple of times. It's pretty clear that only the largest institutions in our studies are actually deploying the Yale model or the endowment model. If you focus your attention on the yellow bars here and even the dark gray, so marketable alternatives, private equity, and venture capital, the underlying premise of the endowment model is that endowments, family offices are looking for intergenerational wealth transfer. They are perpetual entities, meaning it's a going concern forever. It has the longest time horizon of any institutional entity, and therefore we should be exploiting the illiquidity premium that exists in less liquid investments, therefore matching time horizons better. But what you see is really only those institutions that are over 250 million are deploying significant levels of capital in those illiquid, ultra long-term type investments. Now, this is happening for a few reasons. Smaller pools of capital oftentimes simply don't have access to those private equity or venture capital deals. Secondly, many of the smaller institutions don't have the resources to determine a proper fit or to vet private managers and private market managers for use in their portfolios. And then finally, I'd say the smaller the size of capital, the more sensitive you are to fees. You think back to that other slide and building up the required return for our pools of capital. A constituent of that is covering fees. And that is a lever that you can pull. If you're a smaller pool of capital, you want to minimize the amount of fees and expenses that you're deploying, which means you're probably not going to be looking in venture capital and private equity as much. There's a very similar trend that you see in the marketable alternatives. Think of those as hedge funds. By and large, the larger institutions use marketable alternatives or hedge funds as a surrogate or a substitute for fixed income. So you see the mirror image trend in your fixed income allocations, the light blue, going from the larger institutions down to the smaller institutions. And this is, as we'll see, a significant contributor to performance differences, these allocations. But what you see with this declining trend of hedge funds and ultimately an allocation to more fixed income is that the smaller funds are more or less managing to a pretty standard 70-30 or 80-20 type portfolio. So 80% equities, 20% fixed income, or 70% in equities, 30% fixed income. Whereas the larger pools of capital have a very limited amount of capital placed in core fixed income and are actually using hedge funds as the ballast or as a diversifier. Bonds are held in these types of portfolios as the key ballast or diversifier in smaller funds. Finally, the last thing I'll point out in allocations, which really struck me, is in the public equity space. The dark blue public U.S. equities, I mentioned that this is a study on U.S. entities. If you were to compare the allocations of U.S. public equities to a global capitalization weighted on the country dimension, there is a very significant home country bias, meaning they have much higher allocations to U.S. equities than would be justified in a capitalization weighted, think ACWI, MSCI ACWI index, which is the total world market index, including emerging markets. We have a much higher representation of U.S. equities. Now, in the larger institutions that are deploying a lot of capital in private equity and venture capital, note that most of those are still U.S. based. So it's equity beta, it's private equity beta, but it's U.S. private equity beta. So the country allocation and the bias toward domestic equity, whether it's public or private, still exists even in those funds. And for me, that's of particular note, particularly in an environment where U.S. equities continue to show some of the highest valuations relative to the rest of the world's equity market valuations. So those allocation differences lead to performance differences, as I mentioned. All studies, the academic research, and our experience, and then the evidence provided here from this comprehensive study show the differences in performance by size cohort. So those asset allocation differences by size cohort have led to performance at each of the same size cohorts. Now this provides the distribution of performance. What do I mean by that? The dark blue provides your median performance. There's that 30.1% for all the institutions. As you can see, the dark blue declines linearly with a relationship to the size of the fund, reaching, for the largest institutions being on a median basis as high as 36.5%. For the very small funds that are 25 million or less, about 10% lower. Now it provides a distribution because it gives the 25th and 75th percentile results of the funds that are in each of those size cohorts. So we can see how wide the dispersion is by subtracting the yellow square from the light blue square. That's called the interquartile range. That gives us an estimate of how dispersed the outcomes are. And as you'll see, that dispersion actually shrinks as well as we move towards smaller funds. But let me give you some insight into that. As you saw in the prior slide, the larger institutions have allocations toward much higher allocations toward private equity and venture capital. And as you're aware, there's no investable benchmark for private equity. When you invest in a private equity manager, you provide capital to them. They go into the marketplace. They have to source or originate deals or investments that they're going to allocate to, and they build their portfolio up from the cash that you have provided. Whereas in a public equity scenario, you provide cash. Effectively, they buy the benchmark that you're going to measure them against and then deviate from that benchmark as active management. But they're more or less anchored to those public market benchmarks. And that anchoring creates a situation where outcomes at the total fund level, as you as the investor or the allocator, the outcomes you experience are going to be less variable than in a situation where you're investing in private markets. And you are susceptible to A, the manager you've chosen and how good they are. This is also a reason why smaller funds aren't investing in private markets. You have to have access to the best managers. You can't actually obtain the median private equity return. So if you looked at the Cambridge benchmark, you can't actually go out and get that. Whereas if you looked at the S&P as a benchmark, you can go buy the S&P. So that's something to keep in mind. And of course, vintage year. Both of those elements are going to lead to dispersion in results for you as the CIO of the family office, for you as the asset allocator of the foundation. So that's certainly an area we're seeing it come out in the results here. Then the other thing, and I'll actually touch on this in the next slide, is there's a greater allocation to fixed income in the smaller funds, and fixed income, certainly relative to risk assets, underwhelmed in this fiscal year ending June 30th. They've underwhelmed even more in the last 3 months, so it'll be very interesting when we publish next year's annual study. But because of the volatility that we experienced throughout the pandemic and the reflationary period, hedge funds provided actually very, very good returns relative to the last decade's history. So that contributed to this performance differential between large pools of capital and smaller ones. More on that fixed income. This is just a deeper dive on the fixed income. And the reason I wanted to provide this is because it's such an important aspect in how we should be thinking about managing our portfolios on a go-forward basis. As you can see, in terms of fixed income allocations, the vast majority of it's represented in investment grade or core bonds. So you've got a lot of treasury exposure here, you've got a lot of investment grade corporates, but by and large, the results of the fixed income allocations are driven by rates duration, less so credit spread. You have very low allocations to private debt. You have very low allocations to high yield. Cash and cash equivalents are always held as a liquidity buffer. Again, spending needs and the like, deal with capital calls, if you will. But by and large, the fixed income allocation is a core bonds. Interestingly, this past quarter was one of the worst quarters in history for balanced mandates, something like a 60-40. If you have an allocation, even 70-30 or 80-20 for that matter, allocations to core bonds, investment grade fixed income declined rather substantially for the amount of risk you're deploying there. And again, this is due to interest rates rising across the curve. Been parallel shifts in yield curves across the world, largely driven by the inflationary pressures and very high nominal rates of growth. Now, the reason I bring this up and why we need to be thinking about this for the future is bonds or core fixed income have always been viewed as the diversifier in institutional portfolios. It is the ballast. It is what helps manage the equity risk or the risk assets and provides that balance. Let's work through each of the three key, call them utilities, that core bonds bring to a portfolio. Past 30 years, we've experienced a low to negative correlation between risk assets and core bonds. Well, in inflationary environments, our research suggests that correlation moves to a positive number. It certainly goes up. And I'm not talking about inflation of 7-8% like we've been experiencing. Even in the 3 to 4% range, correlation between bonds and equities is in positive territory. So now your diversification argument is going away. Second argument for owning core bonds in the past was it provided decent income. Well, yields are at still low levels. They're increasing, but they're at low levels, which means the carry or the income that you're generating by being allocated to core bonds is de minimis. It's not really providing much. In fact, most of the conversations I have with institutions is around how they can enhance yields away from core bonds. And then the third was, well, when bonds were in a disinflationary period and yields were going down, you got capital appreciation. I would say that yields moving up with the inflationary backdrop, with large fiscal deficits around the globe because of the stimulus that was deployed from the pandemic, that the mark-to-market on core bonds is very much skewed to the downside. So now you're not getting income, you've got a mark-to-market risk, and you've lost the diversification benefit, which means we are faced with determining where to go to source diversification or ballast. Fixed income isn't going to do it. Now, of course, the smaller institutions that have a lot higher allocations to core fixed income are the ones that need to rethink these allocations. The larger institutions are already pretty limited in their allocations to core fixed income. This is just another way of thinking about the interest rate risk and the regime and the environment that we're all facing going forward. What we saw when we did this study with the university endowments is that they were issuing bonds at a higher rate, fixed rate bonds at a higher rate than in the previous fiscal year. And why is this indicative of view? Well, in essence, they're issuing bonds, they're selling bonds in order to raise capital and lock in low interest rates. And one can only deduce that they have an expectation that interest rates are going up. Now, I suspect it's only a matter of time before institutions further reflect this on the asset side. This is the asset side, this is the liability side. They'll start to reflect this by reducing their core fixed income allocations, but very intelligently, the way they started to do this was by issuing or selling fixed rate bonds into the market. At a personal level, a way you can think about this is there was a very large incentive to go buy a piece of property, go buy a house, and take a mortgage out on it, a fixed rate mortgage, whenever it was 3%. Those fixed rate mortgages are now 5% in the US at least. And so you wanted to lock in those lower rates. It's the same thing that these institutions are doing. It's an expectation that interest rates are going nowhere but up. Last year, for those of you that joined the webinar, we did discuss ESG. ESG is still gaining a lot of traction, a lot of momentum in the endowment and foundation communities. You can imagine universities have a variety of stakeholders beyond simply the asset management of those foundations. There are operational considerations, students, the broader community, and the like. As you can see, ESG considerations, impact investing is continuing to become a component or a consideration of how these pools of capital are being managed. About a 10% increase year on year. Now, this isn't to say that they are tangibly and directly embedded and are the decision-making variable for investments I think as fiduciaries, it's still about meeting the long-term objectives. Think back to the required return slide, the long-term objectives of our clients, the families, and the universities' pools of capital that we manage. But bringing in these non-financial considerations continues to be an important aspect. It hasn't been completely adopted yet because, frankly, it's still in its infancy. Data needs to be standardized, and metrics need to be, an ability to measure ESG and what that means, and ultimately what its impact is on risk-adjusted return. The jury's still out on that. And as you can see, though it's creeping up a bit, it's still only about a quarter of the respondents think that responsible investing is actually a source of alpha. It's much more non-financial in nature. Just wanted to provide some context there because it is an important conversation, and one that we're continually having with institutions like yourselves. Finally, this is really the last slide that I'll go over. We have seen a small rise across the board. This is regardless of the size of the pool of funds. We've seen across the board a shift toward full outsourcing of the investment function. Now, most endowments and foundations, family offices, public plans, virtually every institution that I work with has a traditional consultant on retainer. This is taking it a step further. This is moving from a traditional consultant relationship and into full outsourcing of the investments, governance, board, so on and so forth. And I think there's a few reasons why we've seen this uptick across the board from fiscal year 2020 to fiscal year 2021. The first is the sensitivity to fees. OCIO organizations and implementations have an element of bargaining power with the investment organizations like Nuveen, TIAA, Nuveen, have an element of bargaining power when it comes to fees because they combine and source pools of capital from around and ultimately allocate one large sum of capital to a particular manager and can negotiate fees and therefore provide some element of savings to the end client. I think the second reason is investing isn't necessarily these institutions' core function. Yes, they're fiduciaries. Yes, they're stewards of capital, but they're not investment experts that trade the markets 24/7 like I do. And I think understanding that and having access to the resources and being able to be nimble and allocate to those that do this day in and day out makes a lot of sense. You know, a lot of the investment function for these universities or other endowments and foundations reside in the chief financial office or in the treasury office or even in the operating office. It's just a subgroup within one of those offices rather than being an investment organization unto itself. Now, of course, the very large ones, they're their own investment management companies anyway. And then the final thing I would say is we're just coming off the pandemic or the initial shock of the pandemic. And I think this catalyzed a memory around the global financial crisis and some of the extreme events and the decision making that was required with a backdrop and environment in dealing with these rather anomalous times. We did another institutional survey called Equilibrium. I'd urge each of you to go out and look at the results there. It's Nuveen's annual survey on a broad cross-section of institutions. And actually 64% of the respondents in that survey said that they expect more frequent extreme events to adversely impact performance of their portfolios, and this is relative to 2 years ago. Again, the pandemic's fresh in everybody's mind, but it also, again, brings up memories of the global financial crisis and being able to deal with the operational considerations of the university, or to be close with the family or multiple families with which you manage monies for. That relationship management is as or more important, and therefore having these assets outsourced out provides some flexibility. I'd say for us specifically, the conversations I'm having with institutions is around strategic partnerships. I don't do OCIO, but strategic partnerships is a different flavor of working with big pools of capital. What we do is bring Nuveen and the entire platform from a holistic perspective, and simply working with institutions like all of you to determine what their challenges are and how we might help solve them. Again, our expertise is largely from an asset allocation and risk allocation, as well as macro investing perspective. But that strategic partnership model, where those institutions are reducing the number of managers they work with and deepening the relationship with the managers they do work with, i.e. a strategic partnership, I think that trend is going to continue to increase as well. And that's really all the results that we have for the Nacubo study. And with that, I'd be happy to take any questions that any of you might have.
Thank you, Nathan, for quite interesting presentation. I think there's a lot of message you gave us, a lot of information and data. So we have a couple of questions from the audience. For all the audience, remind you, you have the chance to give your present your questions during in the panel. But I will jump into one of the first one that took my attention. You presented the asset allocation before, and then how it's different among different size of institutions, and then you show us the returns they have last year. So I think my question is, it seems there's some correlation between how much their portfolio are invested in the private equity or real asset type of assets. But as you presented before, at the beginning of the presentation, the last year was quite impressive in terms of the returns for those type of assets. So my question, I think, is how this difference between in returns are compared in the long term, or how that difference in the portfolio are, sustainable, looking backwards in terms of the returns. So if you can elaborate on that, will be great. Thank you.
Yes, this is a great question, and actually very interesting, because the average private equity and venture capital returns that we saw in this fiscal year ending that contributed to this 30.6%, these numbers here in the larger institutions, was something that we hadn't seen ever before. Interestingly, just leading up to this year, there was a lot of press, media, and analysis done on how the Yale model or the endowment model might actually be dead, because private market returns up until this year were actually lagging public market returns. And so those larger allocations to the PE and VC areas of the market were actually an opportunity cost from the large institutional perspective versus the smaller ones. They were posting much better total return numbers, and it was because of that allocation difference. Now, I would say in the long term, and from an expectation perspective, private equity can't dominate public equity by that much. is arithmetically not possible. They're both equity beta. It's a function of how the underlying holdings are actually marked to market. We'll receive some compensation for the inability to source liquidity from those investments. But that compensation, I think, is actually declining because there's so much capital that has gone into private markets. So we need to consider that going forward. I think a lot of this is going to normalize itself over the coming years in a big way. I suspect that when we have this conversation next year, the numbers that private equity contribute to total returns for these larger funds will actually be quite disappointing relative to public markets, and you'll actually see this chart shift a bit. But it all over the long term, in essence, work itself out, and that's definitely something to consider. So please be mindful of how anomalous this past year was. I don't think it's going to happen again.
Thank you, Nathan. Makes a lot of sense what you mentioned before. We have a question regarding venture capital. We are seeing from the last couple of years an increasing interest from institutional investors and foundations in the venture capital. A couple of years ago, it was an asset class where there were some questions and try to figure out how to deal with these asset classes compared with risk and return. So if you can, because in your graph, in the asset allocation, you have combined private equity and venture capital. So if you can give more color on what are the venture capital as a asset class itself, difference with the private equity.
Yep. So I would consider venture capital a subsector of private equity. Private equity in this study is generally referring to leveraged buyouts. And these are the largest subsector of private equity investing. This is the barbarians at the gate and everything that we've heard from KKR and the like. Those types of very large institutions engage in this activity where they borrow money, buy out a fund, and the equity, take it private, try and improve its operations, add value, do some financial engineering, and ultimately provide a liquidity event or exit in some years' time. Venture capital, all the way down to seed investing, is really about growth and startup investing. It's about allocating to new industries and companies and areas of the market, providing the initial capital. It's a much riskier subsector of private equity than leveraged buyouts. The allocations to the companies tend to be a lot smaller. And there's a particular type of model that venture capital firms rely on in terms of generating returns. And that model, and this is my interpretation of the sort of approach, no VC fund would actually say this to you, but think of them as allocating to, I'll just pick a number, 10 different companies and providing seed or startup capital to them. And they take a very significant share of ownership in those companies. 9 out of 10 of them are likely to fail. One of them is going to return 10 to 20 times their investment and more than compensate for the losses, the small losses experienced in the other 9 investments. So it very much is about finding and participating in what I call highly convex investments. There's a ton of upside if you're able to invest in that startup venture, if you're able to invest in that startup venture in the ground stages and capture the growth that takes off. A lot of investments really won't go anywhere, which are 2 completely different models and different payoff profiles, as well as different risk profiles. But by and large, they're all private equity. You have to source the deals. You can't find these on exchanges or secondary markets.
Quick question regarding the what you mentioned about fees. You compare what are the fees and expenses the previous year and the last one, and I think I wonder if that increase in fees are connected with the returns private equity had, because usually you have the success fee issue that is very widespread and common in this type of industry. So I think the question is, you're seeing these expenses increasing by the results, or just the fixed fees, or fixed fee and expenses that increase compared with one year to another one?
Yeah, again, great question. It's a combination. Partly fees going up as more capital goes into more expensive type strategies. Now, one way to manage it that we're seeing institutions do is, in essence, barbell, very high active, which I would consider private equity. The entire exposure is all active, with passive investments in the public markets, thereby managing total run rate fee expenses. And then, yes, there is a portion that's being reflected here because private equity managers and hedge funds, private equity managers have a performance fee called carry. Private hedge fund managers have a performance kicker that's over some hurdle rate, provided they've reached their high water mark. Those will all increase existing funds, existing fees, particularly compared to the prior year, where performance fees were a lot lower, for sure. And I think, by and large, the respondents of this study just extrapolate forward the most recent fees. So that is what I would consider an accurate statement. It's going to be a combination of performance fees experienced in 2021, along with a higher run rate.
Thank you, Nathan. We have a couple of minutes to go, just for you to share your questions. I have another one regarding what you mentioned about bonds, and you mentioned that there was the previous three more significant attributes that now are under threat, and you mentioned diversification is not any longer attribute, low yields, and also appreciation. So it's like a combination of very significant trends that in some way can create this question about what do we do with that scenario, moving from these corporate bonds to the high yield. We're seeing some movement in the market from the corporate to the high yields, looking for the need for those type of, I will say, yield and also liquidity in some way. So what are your thoughts, and what are the takeaways for what we are seeing in these asset classes?
Yeah, I think the way to position portfolios on a forward-looking basis is to start reducing the reliance on sovereign bonds, or, from a factor perspective, what I'll call rates duration. So you're moving toward focusing on credit. Now, with investment grade, the credit spread is so compressed that you're not getting a whole lot of credit risk there. You're owning a lot more of that rates duration risk. Can't move into high yield, but even high yield indices have an embedded rates duration because they are fixed rate securities. They have a little bit more of a margin of error because of the credit spread, but that is one area of focus. The most important area of focus is allocating fixed income budgets to floating rate structures. And those floating rate structures take on the credit risk with limited rates duration risk. So think leveraged loans. That's a key difference between leveraged loans and high yield. They're both below investment grade, but leveraged loans are floating rate structures, so actually participate in a rising rate environment and actually correlate quite highly to inflation, whereas fixed rate high yield, corporate bond high yield, does not. So we're seeing this shift into floating rate structures, a focus on credit. All of that will help with diversification. And then looking at other asset classes as your ballast to deal with that one attribute, the correlation attribute. The correlation, you need to find some other diversifiers for your equity. So it's going into income generating, real asset equity, so infrastructure equity, even on the public side, REITs, real estate, Those are all income generating. They participate and have some element of inflation hedging properties, and can be thought of as more defensively postured equity allocations. Those are helpful. And then, of course, as you can imagine, particularly for environments like this, commodities have gained a tremendous amount of interest as of late. Part of that is the performance that they have shown. You know, there's a natural exposure that exists in South America for the asset base in and of itself that exists, but incorporating commodities as a diversifier alongside these other instruments like floating rate securities, and then of course your equity investments, is the trajectory we're on, all funded from these 4 bonds.
I think we are on time. First of all, I want to thank you, Nathan, and also and TIAA as well for sharing with us and our audience this information. Is quite there's a lot of figures and information data there, so it will take time to get a more comprehensive analysis. But definitely was a quite interesting meeting. For all the audience, thank you very much for joining us today, this morning. Hopefully this material will be helpful for your investment criteria and or your plans for the future. And obviously, if you need more information regarding the one that we have shared here, we will happy to share some of them. So please contact the BICE team or your bankers to have more information. And Nathan, once again, thank you very much for joining us this morning. For all the audience, thank you very much for being with BICE this morning, guys. Hope you see you soon.
Thank you all. Bye-bye.
Take care. Huh?
Thank you. You too. Bye.
Bye, guys. Bye-bye.